Sounds good.
Well, good afternoon. Welcome to our February 13th Fat Tuesday edition of Bull Sessions. My name is Mark Robertson. I am joined here by my dear colleagues in investing, Ken Kavula and Matt Spielman. Good afternoon, gentlemen.
Good afternoon, Mark. Good afternoon, Matt. It's great to be here. I need this break. I've been working on paperwork for some of my investment clubs pretty nonstop for the last 4 or 5 days, so I need this break. That's good.
Yeah, you gotta get heads up after that. I've seen this picture before, but I didn't see that I lost a tooth, so now it's a complete picture. It's big enough now. I hadn't seen it on the big screen, just my little phone.
It's a high risk game that we play, when that happens. But
Mark is always ready to add the artistic touch, Matt. Don't worry about it. Okay.
We all have our wars.
Of course, we do have our bull has taken on some George Washington wig action there also to join us. And so President's Day is also in the picture. There's a lot going on, and Valentine's Day is coming up. And, I thought things were going to slow down after Groundhog Day, but things are in pretty much in full gear. So, all right, we're going to talk about software pizza. Take a look at some opportunities in the realm of software, just from one of those graphics from the Quartz gang that are fairly interesting. Then, Ken, you might want to leave the room while we talk about pork for a few minutes. But there was
I was surprised at one of the slides, Mark. When we get there, I'll tell you what I was surprised at. I didn't know.
Okay.
But I'll wait and preserve the anticipation here.
We are going to talk about Buttonwood bolstering, and we'll use some of our exploratory efforts to find opportunities to consider additions to the Buttonwood portfolio. And then I want to share with the audience that I made a decision that I was a little bit tired of some of the forecast volatility at Value Line, believe it or not. And we're going to send their longer term forecast to the penalty box. That's hence the theme for the slide, but that's where we're going. Anything you want to add, guys?
No, I think we have a good range of topics this afternoon, so let's get into them.
So you're comfortable in the role of Paul Newman here, Ken?
Is that me in front there? Am I Paul Newman this week? Okay.
I think that was Paul Newman.
That was better than being the guy in the hot tub, so I'll take it.
Okay. Well, here we couldn't go one more week without Taylor. So here's Taylor and that magical Super Bowl kiss with Travis. And rumor has it that they didn't talk about Disneyland after winning the Super Bowl. They talked about wanting to go to Portillo's. So it's just a rumor. I do not have independent confirmation from that. So sources fed.
I haven't read the article yet, but Natalie carried into me a new magazine that just came in. I still get magazines in the mail, Mark. Okay?
Oh, man.
And this happens to be my latest Bon Appetit magazine. And there's a feature on the 8 best hot dogs in Chicago.
Awesome.
So I'm going to have to read the article, and if it anywhere mentions Portillo's, then I'm going to have to tell you that. I'm kind of glancing over it. I don't see the name Portillo's, but I'll send you what they think are the 8 best hot dogs in Chicago, and then you can give me your opinion.
We'll reel in Kevin Gologly to pass expert. All right. Portillo's is not a sponsor of this show, but they should be. All right. Here we go. No investment recognition is intended. A lot of familiar names in the audience. Welcome back. You guys all know the drill. Everything that we do here is for educational purposes. We are really, really, really big on demonstrating and illustrating at Manifest Investing. In fact, Manifest is built on that notion of illustrating concepts. So we're going to talk about some of the lessons learned over 8 decades with the modern investment club movement, namely how to discover and analyze a company and consider it in the construction of a portfolio. That's the stuff that we'll be talking about here. Please do your own homework, make your own decisions about any company. If we own something, we'll try to remember to disclose that we do, but that rule is actually pretty silly. And we also trust what is. I mean, I would say that to the SEC enforcement person that we know well.
I'm not laughing at you, Mark. I'm laughing at George Mackey's comment that says he thought best and hot dog was an oxymoron.
George, behave down there. We're gonna see George in Chicago. So anyhow, so
Yeah,
when it comes to
we also don't know Kogel's down here at all unless you mail order.
ooh,
Or bring them back with you when you drive, which I have done.
now that is a really local hot dog. Anyhow, all right. So again, make your own decisions about everything you do in the realm of investing, and that is entirely up to you. Our monthly roundtable is actually 1 week deferred to March 5th, I believe, is the date. But that's our monthly webcast. If you'd like to be added to a reminder list about that event, send an email to nkabula1@comcast.net. And then our Buttonwood Duo and Punksy Phil both say if you got anything else on your mind, our two email addresses are there at the bottom of the page. All right.
I think, Mark, that we might be prepared to put together a Kowalski hot dog, a Kogel's hot dog, a Dearborn hot dog, a Kern's sausage dog, and a Willie's hot dog, and have our own blind taste test up here for the best mid-Michigan hot dog, okay?
Oh, I thought maybe it was going to be a battle royale in Chicago.
I could put them in a cooler and bring them to Chicago, and we'll compare them against a Portillo's. All right.
Sounds like, okay, let's get underway and get back to investing. Although hot dogs have been an important part of investing here lately. Okay, the market has once again, until this morning, been red hot, and last I checked, guys, we were down 3%. Is that still persisting to be the case?
The last time I checked, it was 2, so that's news to me at 3. All right.
Well,
Russell's down 3. The others are high ones.
And the
Almost
Russell was hanging in there pretty good to start the day. So, ouch.
Well,
All
that'll
right.
slam a couple groundhog portfolios pretty good, won't it?
Yeah, including mine. All right, here's our look at the market. Again, many people are very familiar with this chart. The green bars are basically the stock market as represented, as shown here by the value line arithmetic index. And I added a couple of notes for people that are a little bit less familiar. The orangish gold or red are simply forecasts over time. So prices go down, forecasts go up, and we're basically at a point pretty close to norms over the last 50 or 60 years that we've tracked the value line. And the average forecast is hanging in there at 10-ish percent. And
Yeah, value line. It's amazing. That's a little bit higher than it usually. It kind of rests a little bit higher, but not a whole percent higher. So that's interesting to me. Very interesting.
Yeah, and all this talk about the S&P 500 being near 5,000, you won't find a single reference out there about the value line arithmetic average being at 10,000, twice as good. And at 10,000, and you can see right here that we are basically back there, at least we were until today. Let me get my Madden pen going here. You can see that up here, we are back at 10,000-ish. It was 98.50 at lunchtime. It had been higher.
Mark, Nick is asking us to explain the new purple line, and I don't see a purple line. Nick, can you explain yourself a little bit more? Is it that horizontal line going straight across the graph that Mark is pointing to with his pen right there? If you could give me a little bit more to go on, we can maybe explain what you're looking for right there. Let's see.
That's just 10,000.
The horizontal line. That's just the line
10,
at 10,000. That's all it is. I'm seeing it as kind of blue color, but if it's purple on your machine, that's the way it is.
Mm-hmm.
Yeah.
And then this was a kind of a fun fact. You're talking about 50 years of investing here, and not having a situation where 14 out of 15 weeks had actually seen an increase. And of course, that's in jeopardy now this week with the CPI data that came out this morning. All right. Here's another look at the last 10 years for the value line arithmetic index, looking at it all by itself. And you can see I captured this a couple days ago when it was hovering above 10,000 momentarily. So we're back at that long-term all-time high in the value line arithmetic index. Okay. All right. So I thought we would kick things off with our 1-week-old groundhogs. This is the top 40. I do want to issue a warning because I'm already starting to get the cards and letters. This does not match what's on Manifest Investing yet. And first of all, it's different most of the time because of the difference in when the prices are actually snapshotted. But second of all, there's a number of portfolios who came in a little bit later than the rest of the group and that sort of thing. And so I need to build those out. I also need to go through and attempt to cover some of the obscure companies that some of you guys added. That's how we discover some pretty interesting ideas. So be patient with that. And the ones that are actually on display on the Manifest Investing homepage will resemble this list very soon. So Ken.
I think, Mark, we should also mention that as the year progresses, as the February 2nd to next February 2nd progresses, the numbers will deviate more and more and more because the numbers that you're showing at a bull session include dividends, and I'm not very positive that the numbers that are on the website includes dividends at all.
Yeah, we don't correct them during the year except in a few special cases. Sometimes the people up at the top of the leaderboard. But what you're looking at on your screen right now is a screen capture from a real-time scorecard that does capture any dividends or stock splits or any of that kind of stuff. So it's all very much real time. And in fact, I believe I moved up from 13th up to like 8th, and then I'm probably back at 28th or something like that now. So anyhow, Marie Frank up at the top. And again, you can go to any of the dashboards at Manifest Investing on the homepage. I'll show you where they're at when we go live. And Marie Frank definitely, first of all, she's one of our small company champions. But second of all, Marie obviously likes technology. I think we're outing her here. There's 4 technologies, and then you can make a case that Paycom is also. So she's
most
making
software is technology too, right?
Yeah. So Marie is head over heels for technology, and it's working out pretty well so far. Because Palantir is an interesting study for anybody who wants to take a look at it. And the broad assets are up there at the top again. And Cass County, newcomer from last year, Four Corners, Antique Warehouse. It's nice to see some new clubs doing fairly well. And yes, everybody, the danger sign is because Ken's monkey is back and annoying us.
Yes, he is. I don't like him up that high. I'm interested to see what the darts chose because as of this morning, his portfolio wasn't in the group on the website. So I'd like to see when we get a chance what the monkey threw the darts at this year. Yeah.
We'll go behind the scenes here because Matt and I just did this.
Oh, all right.
Can you see the screen okay? Other than it's small.
We can see it, can't read it, but we can see it. Yeah.
I'll try to make it so we can read it too. That
All
might
right.
be a little bit more readable because we're clearly in danger. The monkey picked Flex, which I don't even know what that company is, and Run. He may be in trouble there. That's solar with residential solar of some kind. But CP, which is railroad.
Mark, help folks out by telling them what line you're reading across.
I'm reading
Maybe
across
you
the
can
line.
reference it by that line from the far left there.
It's line 30. Can you see the any of the numbers?
Yeah, we can see line 30, right? They're Graham Stevens monkey. Okay.
So Graham Stefan.
Right.
Okay, so he's up there at the top. You can see how these numbers are all shuffled around. That's since lunchtime. You can see how they're not lined up in numerical order anymore. Okay, so the monkey land, and literally this is dart tossing. Any company in our coverage. Flex was the first one. Run was the second one there in that middle column. That's residential solar stuff. CP was his third dart, which is a railroad. DFS is Discover. And then the one that might come back to bite us and keep him up there, Vertex Pharma, which is doing all kinds of stuff with artificial intelligence and CRISPR and all that stuff. Matt, what were you saying they were in the news for today?
Well, not today. They reported earnings last week and had a boost. That's everything before today.
Okay, it's before
the
today.
news. The news says so they own 60% of the Casgevy sickle cell disease treatment, along with CRISPR Therapeutics, and they were saying that they were making quite a bit of progress with the payers already. Right, once you get regulatory approval, you have to get the insurance companies to pay for it, and it's $2.2 million per. But they said they already had a number of eligible patients signed up on a one-for-one basis. And you have to make a contract for this, which makes me think it's some sort of annual payment or milestone payment.
Mm-hmm.
But they even talked about Medicaid. A majority of Medicaid, call it providers, right? Those are state-run government services. Were on the way to approving the treatment. So quite good progress. Not money yet, because you're only officially talking about Q4 of 2023. But a lot further progress, a lot happier talk than I would have expected just a couple months out of that.
So the monkey is more dangerous than he deserves to be. All right. Average groundhog return so far is 3.5. Notice that nearly 80% of you are beating the market as of the start of the day today. It is a return to something more normal, with the value line arithmetic average being ahead of the Wilshire 5000, as you can see there. And Kathy Wood has made a fairly splendid return to the top of this chart also, with her recent performance. And she doesn't do anything slow, does she?
No, and it appears you have to either be at the top or the extreme bottom if you're in that particular portfolio, doesn't it?
She's had a tough time the last couple of years, and
Yep.
and well, we'll see. Wish her the best.
Yeah, she gets beat up pretty badly by a lot of analysts. So
There's a lot of people don't understand, but yeah, some of the stuff she's done is a bit questionable, but oh well, it's early stage investing, guys. That's what it is. And some of us aren't as inclined to do it. All right.
So is our friend Mr. Gologly from Moose Pond Investors, Mark, or is that another DC?
No, that
club?
would be Ty's club, Ty Hughes.
Ty's club, Ty Hughes. Okay, great.
Well, good to see him up there. And Matt, I see you're on the list at 33, so all is well.
Yep, off to a start.
All right. Well, here's that article in the Wall Street Journal, which was just unavoidably interesting, because my grandsons consume enough bacon to at least float the local economy. But the entire article was obsessing over this notion of the pork market as just not behaving itself very well, and just urging all of us to consume pork a little more.
Here's the fact, Mark, that I was really surprised by. I did not realize that Smithfield was Chinese owned.
I wasn't either, and that's clearly there to warn you.
Yeah, Smithfield is a really old U.S. brand.
It certainly is.
But evidently China at some point has picked them up and rolled them into a company. Are they part of a larger worldwide conglomerate, or does China just own Smithfield?
Oh, I think that is a Chinese conglomerate that owns. Okay. I don't know if they own all of Smithfield, but they obviously own probably at least a controlling piece.
Okay. Yeah, they bought them in. They first announced the sale in 2009. Bought them in 2013.
So I don't know. I mean, I Josh Brown's Friday session from a few days ago. They had the guy from J.P. Morgan on. And he was convinced. Well, first of all, Ken, you would enjoy the fact that he said the regional bank stuff is completely overblown. In his opinion, he's got a pretty good track record. He's the chief investment strategist for J.P. Morgan, and or was, and it's just a really good session, and he's kind of warming up a tiny bit. He says you want to be extremely careful with China, but he's saying that there's an awful lot of beaten down stuff in China. He was not specific to the pork opportunities.
Well, here's a good sentence for you, Mark. That pork from China left a bad taste in my mouth. Okay?
Is that from one of our
And
attendees?
I just can't. No, that's from me, and I
Okay.
just can't get over it. So I'm gonna stay away from pork
Oh,
investing. Period.
I'm with you 100%. I still am having trouble pulling the trigger on Chinese investments, especially after that couple segments we did on some of the stuff you have to shake your head about. All right, moving on. This is another interesting kind of a Wall Street Journal article, which this one stunned me a little bit, and it probably shouldn't have. But they're basically talking about the performance of the S&P Composite 1500, which again is going to have your large cap 500, mid cap 400, and small cap 600 embedded in that 1500. And you can read along with me. And that's 90% of the stocks that are out there by market cap. And he basically broke them down. I don't know the actual logistics of how he established those thresholds other than current yield situations, but in the 2% and the 2 to 5% and above 5%, just breaking it down and challenging this notion of dividend investing. Interesting article. I just thought it was kind of important to bring it into context. And the reason I bring it up here, and then I'll let you guys run wild with it, is if you were to wrestle me to the floor and say, okay, Mark, you have to use a dividend strategy to do this, I would by instinct avoid the low and the high and drift towards the 2 to 5s. That's probably what I would even screen for. And I'm just a little bit stunned here to see that would be the weakest performing, at least over this time frame, since the end of 2008, as he cites in the article. I was just a little bit stunned to see. I mean, I know how to be careful and cautious with high dividend situations, but I would have expected those medium dividends to be a little bit better. So what are your thoughts?
Well, Mark, I'm going to indicate that I've held for almost my entire investing career a bias against high-paying dividend companies and even medium-paying dividend companies. Whenever I've been approached to give my opinion about dividend-paying stocks, I've always kind of backed away and refused to get into an argument, because the people that are dividend investors and that believe that's the only way to invest are passionate about that method of investing. But I've always had the instinct that dividend is really not where I'm going to make the best money. And I have never, ever bought a stock because of its dividend, or even looked at a stock because of its dividend. I'm looking purely for growth, and I've been very satisfied, and it's paid me back, innumerable times in the right kind of currency. And this graph I'm going to steal. I'm going to steal this graphic that you have here and use it in a couple classes that I teach for clubs too. I many times go to clubs where they insist that the stock they buy have at least a 2% dividend. That's not where I think we need to be. So thanks for the material.
Yeah, it's a bit distressing, and I will second your notion that this is kind of like walking into a room full of bogleheads and arguing with them about things that they believe in. You're probably not going to convince. At least it's a tougher slog. Matt, do you have any thoughts on the subject?
Well, the statistician in me is suspicious of any data set that begins at the end of 2008, right? Which is 3 months from low of the great financial crisis. If you went to the end of 2023, that would be 15 years, right? So if it was 2013, they went back to, or 2003, some even numbers, kind of a random middle of the cycle thing, I think it'd be fine. Now, I mean, these results, right, is almost 4 times the return on a no dividend as a medium dividend. So I don't think it negates the viewpoint, but maybe it emphasizes it. So I'm a little skeptical at that beginning point, but it would be hard to. These aren't easily made indexes, so I can't just throw up a new time frame and figure that out. But kind of like what you said, Ken, I just had a discussion. I did a club visit yesterday, wonderful club visit, and toward the very end, we had a very similar discussion. You know, we should be looking for dividends to help our total return, and however strong this case is, this would seem to refute that, particularly for a growth-oriented investment group.
Yeah, my concern about the graph, Mark, and it's coming from my background in math and in stat, is that I think there's a fairly good sized number of companies that over this 15-year period move between these graphs. And
Yes,
I
agree
would
with
like
that.
I would like to know a little bit more about the methodology. You know, I have bias to the graph. I really like it because it proves the point that I've always believed. But the rational part of my mind says, how do you actually collect this data? You already made the point that you're not quite sure how he picked the division points, the 2 and the 5. And then how do you collect that data when you know darn well there are companies that have gone from 0 to 3 over the last 15 years, maybe 0 to even higher than 3 over the last 15 years? And what graph do you put them on, or how long do you keep them on a graph before you move the data point? So
Yeah, if I was,
unless they're collecting discrete data every year or every 6 months or every quarter, you know, unless they're doing that.
yeah, that would be quite a task. Maybe something for AI, but um, yeah, yeah. The article is all right here. If you want to go to the link and take a look, he actually provides a link to one of the famous pieces from, I believe it was Fisher, that has the Mogliani stuff and all the dividend discount model stuff. So you can have some fun immersing yourself in it. But since I used his name, I'm in the discussion I had with Bogle at the Morningstar conference many years ago, talked about some of the mythical notions that we have about the contribution of dividends. And he was right on point when he talked about it really is the total return you get from that, and you want to factor the dividend situation into it fairly carefully. So good
Yeah, the
stuff.
article also cites a new book, of course, that's not called The Ownership Dividend.
There's more. Does it come with steak knives too?
Well, but the premise of the book is that, and that may be why they picked this time frame, that it was in part the low interest rate environment which caused this differential, and it may not endure in a more normalized interest rate environment.
Okay.
Not necessarily the point of the article, but the point of the book cited just before this
Right.
graph.
You know, and you want to go back, you know, the time frame from 1940 to 1960, this would have been a different looking graph. Dividends were different back then. So, and then I also mentioned to somebody, we were talking the other day about how we could do a similar analysis on stock buybacks and challenge some notions about stock buybacks. Maybe we'll do that. All right. Well, let's keep pressing on. All right. We just want to take a minute and share some of the rationale as I'm going through and doing some of the updates in the database. And this is the time of year when we switch and we include 2028 as the end of the 3 to 5 year forecast. So there's actually kind of a ratcheting that goes on. So we're going through and auditing all of that sort of thing. And basically, I've made a decision that we have always, and this goes back to the beginning of Manifest Investing, made an effort and have actually embedded that 3 to 5 year estimate in that long-term trend, as shown by the red dotted lines. And I just threw 3 cases up there. I could throw up hundreds and display 100s of these, where that that dot 3 to 5 years out is nowhere near that red line. Even when, and this is what really irritates me, when you draw that trend characteristic through all the historical data and the next couple of years of forecast data, and that red line touches every single point, and then that line way and the dot way out there is obviously in kind of a weird spot. And that creates a distortion in our calculation. And in some cases, I just found it to be a little too volatile and really making a big difference when it didn't need to or it shouldn't have. So we're going to continue to display it so you can see when it appears to be unusual. Now, that doesn't mean they're wrong about these, but you can see that those are definitely, when you look to the far right there, they're off the trend line by quite a bit. And, you know, as I was flipping through and doing this annual ratcheting, some of them flipped from as far below the line to above the line in a single update. And that just makes my stomach turn as a mathematician and a statistician. So now we're going to leave them on display. They'll be in the data, but they will not be used to calculate the slope of that red trend line. I expect it to be temporary, but as the sentence says there, we kicked out S&P fair value estimates a long time ago because they were moving around so much in a single day, and we haven't put them back. So it's been quite an extended time off for that. Ken, did you have any other questions or concerns here?
No, I think it's a wise decision, Mark. Period. It's a wise decision.
All right, so we'll go with it. Continue to watch it. If there does seem to be a little more stability come around, we'll rethink this. But that's just wanted you to be aware of it out there as an audience. All right, so let's go shopping. Ken, Buttonwood. Here's the current status of the portfolio. Hopefully we haven't taken too big of a hit today. We did add United Health before we took our groundhog break last week. So we do have enough cash in the portfolio to make as many as 3 purchases. So I think we go back and do some shopping. Any questions or comments on how we're doing so far?
Well, I'm keeping my eye on the growth. I'm also keeping my eye on the par, and I know what's dropping or what's driving the par down at the moment. It's the cash holding we have, and it's the holding in VUG that we have. So I'm not so worried about that. I am a little bit concerned that Vanguard Growth is keeping that growth figure. I'd kind of like to get a rough idea of our growth without Vanguard Growth, and it's looking to me like maybe 13 is going to hold even without Vanguard Growth in the mix. So with all that being said, I would just like to make sure that we pick something in the par value that's maybe up around the 10, 11, 12% and pick something in the growth number that's maybe double digits. And if we can do that, then I think we're putting together a decent portfolio.
Yep. So we keep pressing on. Yeah, I think all of the characteristics are pretty good. We expect EXLS Technologies, that's the chip firm that's the little brother of Applied Materials. So yeah, this is not an unusual number, but it's the lowest number on the page. All right. So here, this was your suggestion, Ken, so I'll let you talk about why you think this is something we should look for opportunity.
I go back to the chart that you displayed at the last bull session, Mark, that showed that Elfenbein's choices, which he makes once a year and then doesn't change, had a phenomenal, almost unbelievable record of success as far as beating the market. I think his number about his success ratio was up around 75–80%, if I remember correctly.
Oh yeah, he's in Bill Miller land. He's Bill Miller-esque. I mean, he's beaten the market 13 or 14 out of the last 15 or 16 years.
And if you have a success ratio of 80%, then that gives us an 80% chance, and that's greatly simplifying a lot of things.
Yeah, and jinxing us.
Yeah, and jinxing us. But there probably are some really great ideas on this list. I would suggest also that you compare this list against your own portfolio. And if you don't own 3 or 4 of these stocks, maybe here's a place to pick up some of them. I went down the list and found I owned 5 of them on this list that he put together. And they're not, any of them, none of them are new purchases. And it doesn't look like Elfenbein worries a whole lot about finding companies that are, quote, undiscovered, unquote. These are pretty standard companies on this list, and you read down it and you say to yourself, I know 2/3 or 3/4 of these companies. I'm really pleased with a number of them. So
Yeah, I look at it, and I've always called him kind of my medium-sized company champion.
yeah.
And I mean, look at those growth numbers, with a single exception, with maybe Thermo, which we'll be talking about. And this is probably a little bit frisky to the high side, but he's definitely in that medium-sized land of companies that it's a workhorse field of opportunity, I think. So I sorted these by par, Ken. So I thought we would start shopping up at the top. And
Yeah.
what are your current thoughts
I
on?
have a study going on into it right now, Mark, and the only thing that I can say is that they've dived head first, feet first, hands first, everything first into the AI discussion, and hope to turn a lot of their products to become dependent pretty quickly on AI. I'm thinking to myself, one of their prime products is tax preparation software, and if they can connect that in a meaningful way to artificial intelligence, you might have a product that is something that nobody can resist buying. So that's the only thing I'll say about that company. It's certainly not a buy right now, but
Yeah, and it's done pretty well. I mean,
it's kind of been bid up.
Yeah, Fair Isaac and Intuit. There's a couple others. He's had a pretty good run. This would have been selections made at the end of 2023, so $100 each. That's he's had some pretty good runs in companies like Fair Isaac.
And I will tell you, Mark, that I have a small holding in my wife's IRA of the first company on the list, and our story is that people will start buying toys again as soon as interest rates begin to move down, and as soon as they feel that there's not an imminent recession on the horizon. So I don't know when that's going to occur, but we're holding on with Polaris in a relatively small position because we always have liked the company. They make all kinds of vehicles. They originally were known for snowmobiles, but they make all kinds of vehicles now, and you really should take a look at their website if you get a chance, if you're interested in the company. And we think that's pretty spot on growth, but we don't think it's a 5-year growth number. When we did our own SSG, we pegged growth at a little bit heftier number than that, with even discounting the fact that we think it'll probably lose money in the next 18 months.
Yeah,
so that leaves us with Thermo Fisher then. Yeah.
So Matt, do you have any Minnesota-based insights into Polaris, or?
No, I will say when they first brought back the Indian motorcycle, that caught the attention of my dad, who was an auto exec at the time too, and he actually got to spend some time with Polaris's leadership team. Now this is quite a bit before. I was actually just browsing to see how many of the team are still there, and I'm not quite sure. I'm not deep enough into that. He was very impressed with the team, and kind of going to where they are now, what Ken said, the idea of diversifying out from if you say pure entertainment or pure off-road vehicles into other vehicles. That, I think that was just before or during when the Slingshot came out, the kind of 3-wheeled thing with 2 wheels in the front you can see sometimes. So I don't think anything has caught on, quite like hate to throw it out there, Tesla or something like that isn't quite viral, but I think they've done a very good job of diversifying over the last 10 or 15 years from where they were.
Yeah, I always got a big kick out of hanging out with the Polaris people at the Gentex display at the Consumer Electronics Show. And they always had they had their off-road, their four-wheel, wild carts or whatever you call them, and just good stuff in general. But yeah,
That slingshot is quite a vehicle to ride in. Have you ever ridden in one of them, Matt?
No, I haven't.
It's real low to the ground, and you get the feeling that it can go almost anywhere and do almost anything. It's an extremely interesting vehicle to ride around in. Yeah.
interesting. Well, I'm a little bit fearful of Polaris yet. We can always come back to it. I grabbed that second one to dig
Yeah,
into a little bit deeper.
and I'm not pushing Polaris as a new entry into a new portfolio. I think that it sits in our portfolio because we've owned it for a relatively long period of time, and we feel it's a legitimate turnaround candidate coming out of the decline that happened after COVID. They had a pretty decent growth in sales throughout the pandemic, and what they've done right now is kind of flattened out and maybe even gone downhill. Their SSG, their growth lines look a lot like the boat companies like Marine Max or Malibu Boats or
Sure.
companies like that. So we are holding out hope that in the long term, 4 or 5 years down the road, this will match that 19% par that's out there on the right-hand side.
I do think, and we've encouraged this in the past, that Eddy can be an ad hoc member of any investment club. If you have
Yep.
stock watchers that are watching any of these and you subscribe to his free newsletter, he does have a subscription add-on newsletter, but we're going to actually show you what he covered for Thermo Fisher here. So here's that second one on the list. Again, it has not gone very far in the first month of the year, but Thermo Fisher Scientific is quite a formidable company, and I wasn't aware of quite everything that they're up to. What you're looking at here is a company growing in the 10% range. That's this line right here, the red line. So the company has been growing at basically 10% for a long time. Fairly good sized company. They did have a bump up from COVID in this time frame because you'll see what area they work in, and that resulted in a little bit of a lapse back in 2023. Nothing major to be terribly concerned about. We do like to point out that the quality has been strong and consistent over the years. We also point out that the return forecast is at a multi-year high under the current situation. The stock price has been in a trading range for the better part of 3 years, but so have the earnings. So again, a lot will depend on what's going to happen going forward. But you see a low single digit return forecast with a double digit growth rate. So far, it's meeting many of the characteristics that we'd be looking for.
Mark, any significance in the lack of a line between 2018 and 2019 in the sales graph, or is that just a glitch?
Just basically set these years aside as ancient history.
Okay.
But they're still displayed so that you can see that it wouldn't change the graph that much.
The trend line is representing 2019 onward then, right?
Yes.
Okay.
So we're looking at projected return on value of 8, projected annual return of 12-ish. That makes this number a tiny bit suspect, maybe a little bit high on the PE side, but you'll see that they live here quite a bit. So, they're in that high 20s range pretty routinely, so they can defend that turf. So you're talking about, again, they've got a very attractive, I don't know whether these numbers are accurately captured by the analysts or the reports that they're pulled from, but that's a pretty good number if that's what they're paying for interest rate. Value line low total return forecast of 6. You can see both Morningstar and the analyst consensus are feeling pretty good about this company. And again, the profitability pictures are pretty steady. You see the bumps from COVID here, and things are kind of going back to where they were. Here's a longer term look at the company showing you that they have been basically coming down off of that COVID rush that they got and probably headed back to a more characteristic trend. Well, here's some of the stuff that they do. You can see the paragraph at the top is their commercial description of their business, but they're into a lot of very key areas. human genome stuff, a lot of stuff for the labs. They make stuff for labs. That's what they do. And you can see that they're also involved in all of the current buzzword categories. On this slide, we'll look at it in a minute here how Eddy describes what they do. Any questions or comments here, Ken?
No, I have never ever seriously looked at Thermo Fisher, and I've added it to a very short list of companies that I'd like to learn a little bit more about. This is the kind of company that I like to study. I'm wondering how they overlap with some of our like Illumina, for example, in some of these different things. I know that Illumina makes machines that help enable the Human Genome Project as well. So I'd like to see what the overlap is, if there is in fact any overlap.
Yeah, I didn't go that deep into this first cut, Adam. I would encourage anybody to try to begin to understand who are their customers, who are their competitors, and basically perform that next level of analysis. But they're leveraged in with a whole bunch of people. And here's some of their major brand names: Thermo Scientific, Invitrogen, Fisher Scientific. This is all stuff you're going to find in science labs, medical labs, and you can see big company, a lot of people out there. They do invest a fairly significant portion of their proceeds into further research. So a lot of good stuff here. As Ken was just mentioning, the presentation from their investor day is quite extensive, and it does help you understand a lot of the nuts and bolts of what they're into. And
yeah, I think you want to focus on the fact that these folks make a lot of hardware. They make hard things that you can hold in your hand. They're not making intellectual property stuff. They're making hardware to help somebody else create the intellectual property. So it's a pick and shovel kind of company, I think.
In fact, that's what Eddy says. And here's just a sampler from Eddy. He actually added Thermo to their best company list back in 2020. And I just love the way he talks pretty plain speak here. They make stuff for labs. That's what they do. And wherever research money is spent, I just love this guy. Thermo will get its beak wet. And you hear this phrase a lot, but it definitely applies to them. You've heard it for companies like Intuitive Surgical, companies that sell a component and then they sell the stuff to take care of it in continuing service. And
if I were doing an oral report to a group, Mark, I think I'd lift the last sentence in the second paragraph and use that as my lead. You know, it's the arms dealer to the pharma industry. That
right.
Makes a lot of sense. Yeah.
Yeah, very, very timely right now too. Yeah, and then he talks about the PE being up in the 20s, and that's, again, a fairly typical thing. So you can actually go back. You can see where we covered this report from Thermo about Thermo in the Manifest Forum, and that would lead you to that article from his market update. So again, this gives you a feel for how he talks about these companies. When we talk about him being an ad hoc member of an investment club, if you're the stock watcher for Thermo, I think Eddy becomes somebody you can lean on and get some insights. So we'll leave it at that, and I think that's a candidate for purchase, Ken.
I like the concept very much. I like the numbers you've shown us. I don't see anything to hold us back from putting that into the portfolio, Mark.
All right, so it's time to sneak up on our best small companies for 2024. Ken is only giving me permission to do this once a month or so this year, rather than more often than that. And so here's your update. And
shall I give you that quote? Go very, very carefully, Mark. Okay.
Yeah, well, Matt's been throwing Elmer Fudd at me all day long, so you could expect to see Elmer Fudd here as we hunt for shopping opportunities. Here's our companies: 20 companies, best small companies for 2024, ranked from how well they're doing, and we're obviously looking in the bottom half of that list for any potential opportunities to take a closer look. We still like, at least I still like all these companies, Ken. I think you do too. And they're actually performing pretty well since Halloween. And that's all I'm going to
Yeah,
say because that's all
I'm
I have
having
much
a
to
hard
say.
time wrapping my arms around a couple of them, Mark. I still am very lukewarm about Celsius, and I can't figure out why the last one on the list isn't doing better than it is. I
No,
just can't figure it out, and it might be a true rule of 5 candidate for us. You know.
could be. Lantheus makes the stuff that enhances MRI type treatments and that. So they've got a pretty strong track record for basically being another razor blade type company, but they're strictly medical. So we'll see. And from top to bottom here, these are doing okay for us so far. And the one that I kind of singled out, I noticed that of all the ones that the price has been beaten up the most is XL Service. And that also appeared on the most frequently chosen list for our groundhogs in the recent set of selections made. So I kind of zoomed in on that one. I know you know more about this one than I do, Ken. So I'll kind of let you describe the company and we'll take it away.
Yeah, I'm going to characterize this company as Cognizant or Infosys. Those are companies that our community is extremely. Uh, uh, we like those.
Aware, comfortable. Go ahead. Oh, did we lose you, Ken?
I'm not hearing them either.
Ken, you've dropped out. If you can hear
Are
us.
you hearing me at all now?
You dropped out for whatever reason.
Okay,
Now
let's
you're
start
back.
over again. All right.
Okay.
I would characterize this company as the Cognizant or Infosys like business model that we're all pretty familiar with and pretty comfortable with. I know that Cognizant and Infosys are in many of the portfolios that the people we talk to have put together. The big difference in XL Service, first of all, is its size. It's a very small company compared to either of those two that I spoke about. But more importantly, it has a slightly different focus. It's begun to focus its business, almost all of its business, on the cloud and on AI. And they're coming up with ways to make the applications that companies use in the cloud to help companies make those applications more efficient by referencing some of the large language models that they have at their disposal and helping companies create efficiencies in whatever it is they do as far as the cloud is concerned. So it has all the right buzzwords attached to it. It's a fairly interesting but not very in-depth presentation on its website. You can get some ideas about what they do on their website on the investor presentation, but it's not a real in-depth presentation on where they plan to be or where they plan to go. I did write to the we happen to own this in one of the investment clubs I belong to, so I did make a written request of XL. Did they have anything brand new on what their plans were for the future, how they plan to make money specifically in the next 3 to 5 years? And I have yet to hear from their investor relations. I would imagine that a company this size does not have a very robust investor reputation or investor presentation preparer or an investor relations department. I would imagine I'm talking to a single person, and further, I would imagine that they get very few questions like the one I asked. So with all that in mind, Mark's captured some things, and this is coming directly from their investor presentation. I recognize it. They really are very proud of the clients that they've put together throughout the world, and they talk about how many out of the top that they deal with in various categories. You can see that they're very much into insurance companies and healthcare companies. And then they're also working in emerging markets. I find it kind of fascinating that they're being used by 8 of the top 10 banks as well. There's certainly not a lot of overlap between what banks are trying to make more efficient and maybe a healthcare company is trying to make more efficient.
Yeah.
But this the company itself, Excel Service, is willing to take almost any process that the company has and then find ways to make it more efficient. And if it becomes more efficient, then obviously the entire company becomes more efficient that they're trying to help. That's a pretty general description
Yeah,
of what Excel services do,
my
but I think it's enough for you to get a good idea.
yeah, my understanding is they do some really nice risk management optimization type work for the insurance companies that they serve. And when it comes to the banks, the banks do a form of wargaming as they do their risk management stuff, and these guys are apparently pretty good at that also. And so just something to bear in mind. And obviously, anybody who can optimize the heck out of pharmacy benefits has got some pretty good stuff going on. So yeah, I also noticed this one, Ken, is up here. I can see why our people have added it to their groundhog portfolios. Long-term forecast, I think I can see up straight parallel for this company.
Yeah, enough that the history is there and the management has had enough time to make the earnings begin to follow the sales in a pretty decent way. So you can see that this is the kind of company that I'm forever telling people that they should be looking for. A small company where the sales and earnings graph look a lot like a very large, successful up straight and parallel company. That's why I think Mark and I both thought it belonged in our best small companies list. And that's why my One Investment Club decided in an industry study that this was a best of breed. We put it up against Cognizant and Infosys. And when we were finished, we ended up with a pretty much of a tie. We really liked this one, and we really liked Infosys as well. Because of where it's located and the depth of the pool of people that they're able to draw from to expand their business. I'm moving into a different company now, but I just thought I'd throw that in. Infosys, we think, has a lot more reason to continue to grow more quickly than some of the other competitors that do basically the same kind of business they do.
Sure. Now, one thing that I ran into that I wasn't expecting comes, and I thought I would spend just a moment talking about this. We always talk about the RSI, 14-day look-back period, as what is used most commonly on the street. And anytime that gets down below 30, that can be an attractive number. But I also like Len Douglas's money flow index. It's basically an RSI that takes account the amount of volume that's going on. And this is kind of an interesting number for this company. And here's what it looks like on a stock charts page. And you can see what this is suggesting is that for whatever's going on, you have kind of an interesting buying opportunity type nudge. Again, this is the long-term chart, 12-month look-back period using not RSI, but its first cousin, MFI, which is money flow index. And it also, again, it takes into account the amount of volume. So this company has sagged back a little bit off of its 37 back to 25, or a stock price of around 30. So it's come back a little bit, even in a period of strength for the overall market. So it could be a tiny bit of a nudge as a potential opportunity. I don't know if we've got any more on this one. No, so that's the story for XL Service Holdings. All right, and just real quickly, we're up against 3 o'clock. We'll probably dig into this one a little bit deeper. Here's that software pizza, which I find very interesting. It's really kind of fascinating to go through here and kind of kick around some of the companies that you've never heard of before, because I'm willing to bet that there's a few on the page for everybody here. And some of them are private, some of them are Polish, Danish, take your pick. They can be from anywhere in the world, but still that doesn't stop us from taking a closer look at some of these companies that have grown fairly rapidly over the last several years.
Well, and it contains companies, Mark, like Magnificent Seven member Microsoft,
Yes.
and almost Magnificent Seven, in my opinion, Adobe,
Mm-hmm.
down to companies that nobody has probably ever heard of in any way, shape, or form. I see Fortinet on here. I see Oracle on here. So this is quite an interesting collection of companies to maybe come up with a great idea for a good solid medium or even a small company. Size EPAM is on here too. I'm surprised to see.
Yeah, EPAM. I noticed that alarm.com is on here. I mean, that's kind of weird, but yeah, it's just a really interesting shopping list. Here's a company that we discovered in a similar exercise a couple years ago that actually, this is a company that's similar to EXLS services. I believe they operate out of Brazil, so they operate in a different part of the world, but it's a company that Pat Donnelly was familiar with and gave us some insight. So again, I just kind of throw this out there as an area to go kind of kicking around. If you find one of these that is extremely interesting, let us hear about it. I did.
Mark, am I reading that graph correctly that they're actually measuring compounded annual growth rates starting with that, I don't know, Signity maybe is the way you pronounce it,
Signity,
which would be the highest compounded growth rate, and then going around the wheel clockwise to the lowest?
yes.
Is that what I'm thinking about? Okay.
And all of them greater than 15. You'll find that Signity is a private company. They're one of the companies up at the top there might be Seabrain. It is also Polish, pretty good track record, pretty good reputation. But one of them's Danish, one of them's Polish. There's a couple other European alternatives in there also. But yeah, you'll find that some of those are still private.
And according to Morningstar, this is a sister industry to the industry we were just looking at that contains EXLS.
Yes.
This is software and services, and I think EXLS is in an industry called business services, and that might even be in the industrial sector rather than the tech sector. I'm not quite sure.
Could be. In fact, when I went digging, I just went with software infrastructure for quick and dirty comparison. I went in, I looked for companies that had actually made profits, took out the negatives, and just went looking for companies that have an interesting EBIT, which is a form of cash flow, to enterprise value ratio, very much like Prove. It's a cousin to Prove. And so just going down the list, just kind of started kicking around companies. In fact, this Topicus, I believe, is the company that just bought that this Signity. So I think Signity is actually disappearing from the planet, or at least as part of the Topicus team. That dark trace is kind of interesting. I'll show you a picture. Very, very early stage, but you never know what you might find as you go sniffing around these, and this is just a way of sorting through them. Here's just a quick look at some of the companies that are in the database that could be interesting. In this dark
Mark,
trace,
we're getting an interesting question from Nick out there. What would cause an EPS stability number just overnight to go down 10 points? Any idea? He noticed that the EXLS earnings stability number went from 83 to 73, basically in a very short period of time that he was studying the company.
I'd have to look. I don't know what would have caused that.
Okay. All right, maybe you want to make a note and communicate with Nick offline then about that.
I'll take a look at it. If there's anything we need to be concerned about, we'll throw it up on a future bull session. This one I just put out there because this is interesting. Very early stage. Probably not the type of thing we want to chase right now, but these guys are known as one of the earliest entrants into artificial intelligence for cybersecurity. And that all of that adds up to merits further attention, but a little too early right now. So with that, Ken, I think we have a poll for the two companies that were presented. Do you have access to the poll today?
I certainly do. Let's see if I can do something about it here. How about this? Here we go.
Okay, so attendees, we're basically giving you the opportunity to express your opinion on Thermo, EXL services, buy both, or pass on both and shop for something else. And
We're up to 2/3 of our people voting. 70%, 3/4, 80%. So help us out, folks. Just mark one of the 4 ideas there. It's a little bit different kind of poll than we use at the round table, but I think it's easily understood. We're going to give you about 4 or 5 more seconds if you're still trying to make your mind up. And let's close the poll and share the results. Okay. So our audience would like us to buy both of them, Mark.
Okay, I think they're both pretty nice additions to the portfolio. They fit well, and they've got many of the key characteristics, and I'm not going to say any more lest I jinx them.
Yeah, I think and folks, if you're looking at tickers, there's a typo right here. The ticker is EXLS, but I think that one is a little bit more popular than Thermo Scientific, but most folks like both of them, so we're all set. Hide that if I can.
Switch back to me.
Okay.
And we'll wrap up. Again, just with a reminder that we do archive all of these sessions on YouTube under Manifest Investing. You can search on bull sessions or roundtables. We put those here also, along with any educational sessions that we happen to hold. Subscribe, and we'll let you know anytime that new content is added. Did want to point out, I think I mentioned this earlier, that the February roundtable will be on March 5th. That is our black tie red carpet affair. And we have a little bit of a cause for celebration. Look at what our annualized return has actually gotten back to until this morning. Hopefully this morning will be temporary. And then, Ken, I just thought we would celebrate Fat Tuesday with reminiscing about our fairly recent trip down to New Orleans. And I don't know how.
And those look like real punchkis, Mark. Those look real. Those don't look
pretty real. Now, I don't know how they compared to how do you say it? Beignets?
A beignet. Uh-huh.
I don't know how they compare. So we might have to do another field trip to New Orleans.
Beignets are fried dough. They have the same powdered sugar topping, but no filling in them. And one of them is a raised dough, and one of them is a slightly raised dough. But they're kissing cousins of each other, Mark. Okay.
Okay. Well, we have to do some field research by way of Punxsutawney.
Mark, we're getting a nice question from Fred out in the audience here. He's wondering where all these nice graphs that you're showing, all the bar graphs, come from. He's wanting to know if Value Line generates them for you. Fred, it's just the spreadsheet that Mark collects all the data on in order to maintain Manifest Investing. And then Excel will allow you to make these really nice, whether they're typical graphs like this one or whether they're bar graphs like the next slide is showing. Excel will allow you to make these graphs when you tell it what data to use. So Mark is generating the graphs from his Excel spreadsheet. Is that a pretty good answer, Mark?
Yeah, and then, as far as they're all connected to the data feed, so it's not something that is totally shared unless a couple thousand of you get together and decide you want to pay a couple $100 each. Then we could do something with that. But what I wanted to show you is that we have been putting on the homepage, in case any of you are not familiar with this. Let me go ahead and bump it up in size a little bit. See that okay, Ken?
A little bit bigger yet, Mark, if you can. A little bit more.
It's catching up. I think it's catching
All right.
up. All right. So on the homepage, when we do our weekly updates, we have been including direct hot links, if you want to call them that, to any of these companies. So for example, Texas Roadhouse. You just click right through. You can see what the track record is. And this one I actually included a little bit of commentary about. This is a great example of Cy Lynch's temporary versus terminal thing that he talks about quite often. But you can see that it's all here for, in this case, Texas Roadhouse. Here's Starbucks. Same type of situation. So you can access these right from the homepage, and they are all embedded in the forum under stocks also. So in the case of McDonald's, for example, I'm pretty sure it's here. So again, we just generate those. I think that they give a pretty good top to bottom view of the company as you do your research. You can see the different opinions and can be a pretty good resource. Anything else, Ken?
No, we've caught up for the most part on questions that folks are asking, and George is telling us that he can recommend the beignets at the Brick and Spoon in Tupelo, Mississippi. Best I ever tasted. Okay.
Okay.
So, all right.
Well, we got to add Tupelo to our Punxsutawney list.
So with all that, I'm going to say good afternoon. Thanks for coming, folks. It's really appreciated.
Thanks for the help, Matt.
No worries. It's always fun.
Our corporate insurance will cover that trip to the dentist to take care of that hockey injury.
I'm gonna just wait till my salary demands go up for the.
All right. Take care out there, everybody.
Good afternoon, folks.
Thanks for joining us.